Welcome to YieldNerd, an educational show about how you can acquire and manage yield. All right, yield nerds, we are going to kick into high gear with respect to preferred stocks shortly. And before I do that, I want to remind you of something very basic. I am noticing that the number of views of later episodes are higher than the number of views of earlier episodes. What that tells me is that you are not exactly watching the episodes in order. And the easiest way to watch Yield Nerd episodes in order is to use the playlist. On your YouTube, you should be able to see the playlists. If you see that you've seen episode 17, but you have not seen episode 16 and so on, please make sure you fill in the gaps because we are going to accelerate and make it more complicated. And I will reuse concepts from previous episodes even if you're familiar with some things and not the others. Maybe you know a lot about treasuries, you don't know a lot about preferreds. I will use analogies such as tomato farms and lobster farms. So there's a lot of context sensitive terminology. So I would suggest that you catch up using the playlists and not skip ahead. Now that I've said that, let's jump right into picking up from the previous episode, which I hope you have watched. And we were talking about the types of preferred stock and the risks of preferred stock. And then we wanted to talk about some ideas on how you can decrease your risk. And while we talk about that, let's just remind ourselves how the risk stratification is really laid out. The extremely low risk income asset is the United States Treasury. The next step along the way is the agency bond. And you may remember some agency bonds are state and local tax exempt and others are not. So watch out. The next lowish risk is muni bonds, and there are some tax related implications there. And please make sure you look at that episode if you're not familiar with it. I happen to take a different stand in using effective tax rate and not marginal tax rate, so you may want to go back and review that. We then talked about corporate investment grades bonds, and now we're talking about preferred stocks. So clearly, you are higher up in the risk ladder. And having said that, the question then is how do you evaluate a preferred stock? The concept is not too different from evaluating a bond or an equity for that matter. There really are two things to look at in a preferred stock. Who is the issuer? What is the underlying equity? And what is the instrument? What are the parameters of the preferred stock? And so let's actually start with the issuer. Very much like we did with the bond, we want to make sure this company is going to last, they have good profit, they have money in the bank, they are paying dividends and so on. So the first thing we're going to look at in terms of a particular equity is the financial health. How much debt do they have in the books? If they have a much higher debt on their books compared to their peers, you may want to rethink owning that preferred stock. The second thing is debt to EBITDA. A company may have low debt, but if they are making a huge loss or they don't have a good enough debt to EBITDA ratio, it means debt service is going to be a big burden for them, and you may want to look at that as a red flag. The next thing is the company performance itself. They may not have a lot of debt, they may even make a profit. Is their sales growing? The reason you want to look at that is a preferred stock has characteristics of a bond. So you want to make sure they are going to be around for the next couple of years or whatever duration is left in the preferred stock. So that is why you would look at that. The next thing is their earnings growth. Remember, dividends come from earnings. And if their earnings are not growing, at some point they may have a cash crunch. And so you want to make sure you carefully monitor that. The last but not the least is to truly think about the business. There may be a company that is fantastic on the books, but they may be in the wrong industry. When I say the wrong industry, it might be the wrong business for this time. I would remind you there used to be a company called Blockbuster, which was a wonderful company until it was not. So who is their competitor or who are their competitors? What are the threats that are likely to come to their industry? Can they come from outside the industry? What do you believe about that? And a lot of this you can do research, but you also need to use your own time to do your own research and not just trust an analyst report. No offense to any analysts out there. So the next question is to truly bring your knowledge. What do you know about the company? What do you know about the industry? Maybe you can look at industry reports and credit history and so on and so forth, but make sure that you do a lot of diligence about the issuer. The next question is, now that you've done the issuer, you really, in a preferred stock, it is a dividend that you're investing. So you want to go very carefully look at dividends. Has this company been paying their common stock dividends all the time? You can look at dividend history. They are obliged to pay their preferred stock dividends as long as it is a cumulative preferred stock. So how are they doing on that? How much money do they have to pay dividends? What is their dividend coverage ratio? Very, very important. The next part, and I enjoy using this metric, and it kind of is an eye opener in some ways, and it is called enterprise value. Let me explain what that is. If you were to take all the money in your bank and go buy every single common stock available in that company at today's market price, that is called market cap. So let's say a company had 100 stocks and each stock traded for $10. You would spend $1,000 to buy all the stock in the company. Well, now that you have all the stock in the company, oops, you also need to pay off their debt. Let's say that the company had a debt of $100. Well, you spent 1,000 to buy the stock. You're going to spend another 100 to pay off their debt. So you're out 1,100. And then you're going to look in their bank account because you're now the sole owner of that company and take the cash in the bank and say, whoo, I got some relief. Well, let's say the company had $1 in their bank account. That is all they had. Well, you're out 1,100, you're up $1, so you're in total out $1,099. Let's look at an actual example so we can dig deeper. If the company's market cap is $1 billion and they had debt of 300 million, remember the average leverage ratio is north of 40% for the country, unfortunately, and they had 50 million of cash in the bank, you would have gone and spent your money. You would have spent $1 billion to buy all of their stock. You would then still need to pay off their debt. So you really are out 1.3 billion. But then you got to take the 50 million in cash from their bank. So the enterprise value of this company is 1.25 billion. Then you ask the question, gee, I wonder what other examples are there? Let's look at another example for enterprise value. Market cap, same company, 1.5 billion, except they have no debt on the books. This is a rarity, as you know, but you can find these in every industry. And they are sitting on a giant pile of cash. Again, it happens. Now you spent $1.5 billion to buy this company. You didn't have to pay off any debt, and you got to enjoy the benefits of the 500 million of cash. When your enterprise value is less than market cap, what it is telling you is they are low on debt and high on cash. When your enterprise value is higher than the market cap, that means they are high on debt and low on cash. And you can use this single number, and it's available on most brokerages, and sit there and say, what is their enterprise value? It's a very good tool for you to do a sniff test on a company, especially when it comes to preferred stocks. Okay, so the moral of the story is you want the lower enterprise value compared to the market cap. You want a high dividend coverage ratio, and those give you comfort that indeed you're going to get the cumulative or non-cumulative preferred stock paid off until it matures. And so we kind of have looked at the issuer a lot. We've gotten some comfort about who will continue to pay. And now let's look at the preferred stock itself and dive deeper. So in this scenario, what we are going to do is treat the preferred stock like it's a bond. So instead of getting a preferred stock that has no maturity, which is the indefinite preferred stock, we looked at the type of preferred stocks. You may want to look at a preferred stock that matures in a year, 2 years, 5 years, whatever your duration is. And that is one thing you can do. You also want to buy companies that have an excellent track record in terms of paying their common stock dividend, so you can have some assurance that they've always had the money to meet their common stock obligations, which by definition means they also met their preferred stock obligations. You want to look at cumulative preferreds first, so you will not get stiffed. The non-cumulatives carry a higher risk, as you know. And lastly, If you are buying a callable preferred and you're paying above par, you literally are taking a risk that the very next day that preferred stock could get called. And if you bought something for 103 and the par value is 100, you're out $3 in one day. So that is a raw deal. So if you're buying a preferred above par and it's a callable preferred, please make sure you know what you're doing. Okay, now we're going to go on to the next part of our unit, and we're going to come up on some very exciting things such as the convertible arbitrage and things like that. So before I do that, I'm going to once again do a very light quote of the yield curve, and I would encourage you to go back and watch previous episodes if that does not ring a bell. The example we've been using is the tomato farm. If you ask me for $100 and I give you the $100 and you tell me you'll give me $2 every 6 months, and your tomato farm is going to be set up and cashed out in 2 years, that is one kind of risk. If you say that you will return my $100 in 10 years, arguably that's a higher risk. So you should ask me for a bigger coupon if you want to keep my money longer. And as you may have seen in prior episodes, the yield curve is inverted. At some point, it pays you less to lend money for a longer period, and that's a head scratcher. And that is where the treasuries are today. We did see the table earlier. We saw that treasuries are state and local tax exempt. And so with that as the backdrop, preferreds have no such benefit. Preferreds are absolutely taxable. There are some preferreds in certain conditions that have the long-term capital gains treatment, but you have to read the prospectus to know that. So we'll discuss more of that when we get to tax implications. So then the question is, how do we get underneath the covers on preferred stocks? And so what we are going to do, and I'm showing Schwab, and I've repeated many times, I do not have any allegiance to Schwab. I am not paid by them. This is not an advertisement for you to go get them. In order to get into preferred stocks on Schwab, you would go into the menu called research, and then you would go into stocks. And once you're in stocks, there is an area that says preferred screener. That is where you would start your due diligence on preferred stocks. We're going to stop right there, and we're going to pick up from diving deeper into preferred stocks in the next part. Thank you. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.